When it comes to real estate investment trusts, I think the first one that I ever heard of when I began my investing journey was Rio Can. I sure do know all the big YouTubers at the time sure did like to talk about them quite a lot. Even still, it has been my experience that this is one of our community's favorite REITs. In this video, we will take a deeper look at Rio Can and find out if they are worth all the hype. Is it true they are turning into a bit of a growth stock? What's going on with that? Stick around as we answer that question as we dive into Rio Can, and we will begin right now. Before we break into their fundamentals, let's take a quick overview of the company. So Rio Can is without a doubt one of Canada's largest real estate investment trusts, or REITs. Their investment strategy is tied mainly into a retail-focused portfolio of properties. They do also have office and residential spaces to help diversify their holdings. Smart. Within their retail holdings, they are mostly grocery, pharmacy, liquor, personal services, value, and specialty retailers. Some of these retailers include Loblaws, Canadian Tire, Winners, HomeSense, Shoppers Drug Mart, and Metro. These are some very stable tenants, and that goes a long way towards establishing a lot of stability in this REIT. Rio Can also loves properties with a significant redevelopment potential. These will almost always be in high growth, high population hubs, which make it much easier to get a return on their investment. On their retail side, Rio Can Living specializes in best-in-class, purpose-built rental units, as well as high and luxury condos. All of their retail properties are situated on major transit hubs, so basically it is all about location, location, and location. As of September of 2021, Rio Can had 600 employees and 207 properties. 91% of their revenue was from 6 of Canada's major markets, with just more than half of that coming from the Greater Toronto Area, or GTA as they like to call it. They maintain a committed occupancy rate of 96.8%. They also sported a total enterprise value of $13.9 billion. Not too shabby. From this alone, I am definitely liking my initial glance at the company. I am also impressed with their core values of bold, adaptable, entrepreneurial, responsible, and trusted. Those are definitely some values I can get behind. No matter how well they look on the surface, as investors, we need to peel back the layers and look a little deeper to see if they are right for our portfolios. Let's look at Rio Can, ticker REI.UN, and see some of their initial numbers. Their dividend yield is 4.075%, which is pretty good for the level of stability I'm seeing in this company. They pay out their dividends monthly in the amount of 8.5 cents per share. They have an EPS, earnings per share, of 1.89, which is actually quite fantastic for a REIT. Their price to earnings ratio, or PE ratio, is 13.20, which is also not too bad. Now, let's look at their growth. Normally, a REIT is not a great choice for a growth stock, but wow, Rio Can forgot to take that memo as their share price rose from $20.30 to $25.03 for a return on investment, or ROI, of 23.3%. Just last month, that price has been as high as $26.11. This is absolutely fantastic. Of course, looking at a one-year time frame doesn't really give us the full picture of what's going on with Rio Can. Yes, it's true, they do look after a lot of retail spaces, so you have to wonder if reopening over the last year played a major part in this awesome growth rate. The answer to that is yes. Their share price before the illness was around $27. They did take a deep dive in February of 2020 when the illness was making itself known, falling from $27.82 to $13.76. This last year's growth has been them just getting back to where they have been in the past. So when I asked if they were a growth company, they are not. In fact, for the last 10 years, their share price has been pretty reliable in the fact that it does not waver too far from the $27 mark. However, what this growth over the last year does tell us is that they are very resilient as a company, and this makes them a very safe investment. Jumping in now is not a terrible idea, as they are still well below that $27 mark, so I would expect their share price to rise a few more dollars over the remainder of 2022 or even into the beginning of 2023. Of course, if you are interested in investing in this REIT, just remember that this video is the beginning of your research. A financial advisor is the end. Once you do reach the end, be sure to invest with Canada's favorite commission-free broker, Wealthsimple. My link pinned in the first comment will start you on your way with 2 free shares. Definitely a great way to begin your investing journey. Let me know in the comments below what 2 free shares you got. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.